Okay, so let's start the question. This is the question number 1, unit number 1. These are 3 units for ratio analysis and testing your knowledge about do you understand the financial statements and do you know the components like balance sheet, income statement, equity and all that. So the first question is the basic financial statements include what? Generally, when we say financial statement is a set of documents, which is a statement of financial position, which we call as balance sheet, income statement, cash flows, notes to the accounts, that is for the disclosures. So if we see that D option, statement of financial position, which is showing your assets, liabilities and equity. Income statement is showing your expense and income. And the statement of cash flows showing like income from operating activities, income from financing activities and income from investing activities. And statement of retained earning, that is the shareholding portion where we see the net profit, opening retained earnings, changes in equity and the closing balances. Next question is, what is the primary object of external financial reporting? Means why we make financial statements. Of course, if it is a listed company and people have invested in this company, so they want to know that what is your financial strength and health. Therefore, we make we do external reporting. So provision of information that is useful to present and for potential investors, creditors and other in making rational financial decision regarding the enterprise. If you are an investor, you want to invest in Nestle or some other company, how you will invest? First of all, you should know that what is the financial strength like balance sheet, income statement, cash flows. This will let you know that this company is good, and same like you will do other companies analysis, and this is how you will compare both and take your decisions for the investments. Notes to the financial statements are beneficial in meeting the disclosures required of financial reporting. The note should not be used to. First of all, why we use notes? What is notes? Notes are the additional disclosure explaining the calculations done in balance sheet, income statement and cash flows and statement of equity. So what we should not do in notes, So let's put it in this way, what we should do in notes. First of all, we should give calculations, show how the working has been done. But if you correct an improper presentations in financial statements, this should not be in the notes. Notes are just explaining your summaries, 1, 2, 3 points and policies and other things in more details. The primary purpose of the statement of financial position, what is the basic purpose of financial statement is, if you see fair value of firm, fair value is just a review. Your assets, equity are on the cost basis in the financial statements, right?
Yes.
Status of firm asset in case of forced liquidation, even there is no liquidation, then we still show the financial statements. Success of the company operations, that will be in income statement only. Item of value means asset, debts mean liability, net worth means equity. So D is the most primary purpose of the statement of financial positions. It says prepaid expenses are valued on the statement of financial position as how? Any prepaid, any asset that we show is generally shows as cost less anything like depreciation or anything related to that particular class of asset. Same way, cost less expired or used portion. For example, you paid for 1 year and after 6 months December came. So 6 months is your expense and 6 months is your asset. So you have to show the full value that you paid as advance, less any expired portion of these assets. In this example is the prepaid rent, prepaid insurance, something like this. This you show as a total amount less the expensed portion. So D is the right answer. Now we have a question which is more in calculation. The company is pre-closing trial balance and other pertinent information on 31st December are as follows. The opening balance of inventory was 140,000. The long-term debt pays interest at the rate of 10% per annum. So the interest calculation is on 10%, payable every 12 months. So liabilities after for 12 months. The debt was issued on July 1st of the current year and originally had 5 years to maturity. So it's a long-term commitment that you have to pay for 5 years. The fixed asset has a useful life and were 1 year old at the start of the current year. So depreciation can be started because it's 1 year old. Straight line depreciation is used by the company. If you see your trial balance, inventory is always debit, account receipt, all assets are generally debited in accounts. But this is just for your information. This is not a test of debit and credit. It's a test of more how you apply the financial skills, right, in terms of ratios. Assets accumulated depreciation, because it depreciates the assets, so it is always credit. All liabilities are credit. Stock equity is always credit. Retained earnings credit. If it is a profit, if it is a loss, then it is debited. It's like an expense. Sale revenue, sale income always credit. Purchases always debit, and any expense is always debit. Okay. He says a statement of financial position that allows investor to assess all of the following means when we see balance sheet, income statement, cash flows, what we can assess from it. And this is one question. One is what we cannot assess from it. So if you see, we can see efficiency, liquidity we can see because current assets minus current liabilities. Capital structure we can see like equity, retained earnings. But net realizable value of entire enterprise asset, this is, we cannot see from a balance sheet, because what is net realizable value? This is, if I want to sell a car, this car is $100,000 and I have to spend like some expenses to make it sellable, like $10,000, right? So 90,000 is my NRV, net realizable value, right? Which I cannot see from balance sheet, because balance sheet is generally for cost, cost themselves, not market value, not NRVs. Okay, it's an easy question like the accounting equation, assets minus. Okay, he says the accounting equation, equity is equal to asset minus liability, reflect what? Equity, owner's mindset, right? Equity is the owner money, right?
Yeah.
So what it reflects is proprietary point of view, means owner point of view. Because if I put only assets, equity minus liabilities, this is another angle. It's telling the company resources.
Yes.
But when he says equity is equal to this one, means owner's perspective, right?
Yes.
Proprietary point of view. Okay, according to SFAS 78 classification of obligations, Illinois is asking the classifications, what is asset, liability, according to the classification, that obligation that are called by the creditors, long-term obligation that are or will become callable by the creditor because of the debtor violation of a provision of debt agreement at the balance sheet date should be classified as what?